Hey guys, today we interviewed Kenny Bedwell from STR Insights, as well as a member of the short-term rental wealth super team. Man, it was awesome interviewing Kenny because we talked about a little bit about his background working as a data analyst at his W-2 job to transitioning to self-employment full-time using his tool STR Insights. It's a data tool. Guys, if you haven't checked that out yet, we're going to talk about it in the podcast, but you literally can filter what your specific property is, like what do you want based on price, geographical location, bedroom count, etc., revenue numbers, all these different types of things that you are not able to do with AirDNA or Data Rabu. We talked about some of the struggles as scaling our businesses as well as our short-term rental portfolios. We talked about buyer tendencies and markets, where investors looking to buy based on their profile. And then we just talked about the overall risk and things that we've seen working with hundreds of investors between ourselves. So it was an awesome podcast today and you guys are in for a treat. Without further ado, let's get into the episode. Hey guys, before we get into the episode today, I really want to shout out my Facebook group, Tax Strategies for Real Estate Investors. So we have over 5,000 real estate investors in this group from all walks of life. We have long-term rentals, multifamily, mid-term rentals, short-term rentals, commercial properties, syndications, and everything in between. We have people that are co-hosting in there. We have people that are property managing in there. So make sure to join today because we talk about all sorts of things between tax strategies and real estate management, portfolio management, and absolutely everything you can imagine. So if you have questions for me, this is the easiest way to get access to me is to join this group and ask your question. So without further ado, let's get into the episode. Hey guys, welcome back to the Learn Like a CPA show. I'm your host, Ryan Bakey, with my good friend today, Kenny Bedwell from STR Insights. Kenny is a member of our super team, as well as a member of our mastermind group. I've gotten to know Kenny for about a year and a half, almost 2 years now. And I met Kenny when he was still working at Citibank as a data analyst, and now he has a full-fledged team helping short-term rental owners and potential owners identify markets and buy properties. So Kenny, I want to let you introduce yourself a little bit.
Thanks, Ryan. Yeah, so I, like Ryan was saying, I'm the founder and CEO of STR Insights, but I'm also a short-term rental investor. I have 6 properties that I own and manage in and around. I live in Western New York, so Buffalo, New York. My properties are in Buffalo, Niagara Falls, and then Central New York, Watkins Glen, if anybody knows where that is. I love STR investing, but I'm also a data nerd. I love the numbers behind, what does well in markets and what markets are doing well and where people should invest. And so that's kind of my specialty, is helping people identify, the right markets for them and then where in that market they should be investing.
Wow. So you have 6 properties that you own and manage yourself, right? Do you do any co-hosting?
I used to, so I'm kind of getting rid of, due to time constraints and everything, I am getting rid of those properties. But yeah, I've done some co-hosting. I've done rental arbitrage. It's literally own, manage, co-hosting, and arbitrage. So I've done it all.
and you talked about this Watkins Glen property. How were you, because I've never heard of that market, let alone I don't know anybody that actually invests in New York outside of you. I have some clients that are in New Hampshire. New Hampshire's kind of popular on some lake markets, and I even had one client do really well up in Maine, but I've never actually had anybody that's invested in New York. Can you tell me a little bit more about how you kind of found that property?
Yeah. So it's New York. There's a lot of states that are just kind of low key, really, really well for short-term rentals because of the housing prices. So. Watkins Glen has a state park where 1 million people go through it every year. Beautiful state park. It's a town of maybe 1,500 people. There's no really major hotels there. There's a NASCAR racetrack there. There's wineries. There's a huge lake. That's where it sits on. So there's a lot of traffic drivers, and it's 4 hours from New York City. So, and 5 hours from Pittsburgh, 2.5 from Buffalo. 1.5 from Rochester. So there's a lot of big cities nearby. And so, but I hadn't heard of Watkins Glen before I invested in it either, even though I was near it. And I found it through looking at the data. What data was I looking at? I was looking at housing prices and average revenue across markets to see what I could afford and then would fit my preferences. So I wanted to find a property within 4 hours driving distance. So that kind of put a criteria around where I could invest. And so, a list of markets popped up and Watkins Glen was up at the top. So that's how I found it.
I know one of the big things you talk about is the traffic drivers, and I know from experience that the NASCAR and the big stadiums is a huge thing. I know for us, for my new ground up construction project in Branson, we found out that NASCAR just got licensed to have their events there, kind of like the big, Daytona 500, or like they have the Indy 500, like a major flagship event there, and that's just a huge traffic driver and a big compression event in my opinion. But then also think about how many other sort of outfits and events they're going to have at that racetrack as well. And it's just a huge traffic driver.
Yeah, the cool thing about the track is they have races. So they start mid-April. They have like a weekend. They open it up. It's kind of cool, actually. The first one is anybody. So they allow everybody, the public. You can show up, you sign a waiver, and you can drive any vehicle you want, like that you have. And you can race it on the track. You just have to follow a lead car, and you're not allowed to pass anybody. And so so they start that. That's like the first of the year true race, and then all the way from middle of April till about the end of September, they have races every weekend. They could be big Formula One, all the way down to classic car races and stuff. It's really cool all the stuff they do there. But yes, you have those major compression events, but then there's always something going on the weekends there. So
let's dive in a little bit to your tool that you developed and that you use to kind of help find your Watkins Glen property. I know from using it and kind of firsthand experience with you that you have 4 sort of big identifying pillars when it comes to helping investors find properties. Can you touch a little bit on those 4 pillars?
Absolutely. So I guess just to clarify too, so the tool is the data, but what you're talking about, the pillars, is understanding the concepts before we even start looking at the data. Because what I've seen is that, when I tell people, because everybody wants to know, Kenny, tell me the top markets in the country. But in reality, my top markets are different than your top markets because we have personal biases. We have personal preferences in where we want to invest and what we see is doing well too. Even if you look at the numbers, some of the best markets in the country are, in Michigan, Pennsylvania, but there aren't a lot of investors who want to invest there. So they kind of, fall asleep and turn away from that. And so for me, it's understanding and identifying the personal preferences of each individual. So talking about the pillars though, this is more on the logical side. So not only is it identifying where and what you kind of want to invest in, you also have to match your goals. And so that's where that goes in with the pillars. So the 4 pillars for me for short-term rental investing are cash on cash returns, cash flow, tax savings, and appreciation.
Mm-hmm. And that's so right, because I know you've talked about it with Patrick Switek before, and just how I remember listening to your podcast, and you said that from a ROI perspective, like a gross ROI perspective, Michigan tends to be the best market, but not everybody here wants to go to Michigan to vacation. In high school and college, the thing used to be we used to drive to Michigan, and we used to go on the lower side of the mitten east. I would say lower west side of the mitten, like South Haven, Michigan, and St. Joseph. Those used to be pretty popular areas to go to, but some of those towns have completely banned short-term rentals. But I do understand that there are a few markets, especially at the top of Michigan, that are really good for STRs. But, would I personally want to invest there? Probably not. I already have a few properties in the Midwest, and I'm, dealing especially with, right now, with it being winter, the properties are harder to book. Your Midwest properties are going to have a slow time during the winter. And so, maybe think about strategizing. So for you to say your best market is not going to be somebody else's best market is exactly right, in my opinion.
Yeah. And it's understanding timing too, seasonality, timing of when you invest in that market. So for me too, and to go back to the pillars here, every market. I see, this is coming from my background at Citibank, where I was a research analyst studying, the equities market and stocks. So when we go and we look at stocks, a lot of times if you go in like Fidelity or some of these other brokerages and you're looking at stock performance, not necessarily like the histogram charts or bar charts of the historics, but of the health and well-being of a stock, they give it like a ranking score. They'll say this Amazon, the health of this company is a 77. The revenue potential is a 46, and so on. Like they have like 5 different metrics or whatever, and every brokerage has different ratings and scores, and it's all different. But it helps the investor, I guess, categorize or just basically identify what their focus is, and for them to understand if it's a good stock they want to purchase. And for me, I see every market, short-term rental market, as the same, but with the cash on cash flow, tax savings, and appreciation. Meaning that, these markets, will pick on Michigan again. These markets in Michigan have a really high cash on cash return, meaning that you can go out and you can find, low priced properties and then have a decent revenue and get that return quickly. However, the cash flow isn't as high as some of the traditional vacation markets in, say, Florida or Tennessee or North Carolina, even in California. So, and then finally, the tax savings. You get greater tax savings, in the South or Ohio than in Michigan. And then appreciation. Obviously, a lot of those properties aren't going to appreciate as much as properties in other markets as well. And so every market, if you're focused solely on cash, then Michigan could be a good play for you. But if you're wanting more cash flow, or you're wanting to really maximize a cost segregation or tax savings in a particular market, or maximize appreciation, maybe Michigan isn't the best overall market based on your criteria. And so it's really understanding and diving into each of these 4 criteria and where you sit is how I always start or the questions I ask when I'm helping someone identify a market.
Yeah, I remember when I had my light bulb moment of, really understanding the difference between cash on cash return, having a high cash on cash return, but then actually having a high cash flow amount. And it really seems, as owning a few properties in the Midwest, it seems like you will get a pretty good cash on cash return. However, the total cash flow amount is going to be not what you're going to get in those other markets. So I'll give you an example of my deal. So I hover around 43 to 45% cash on cash return on my property in Ohio. However, it's only going to cash flow me maybe 35, 40 grand a year in that particular property, net cash flow after all expenses are paid. So it's I'm getting my money paid back within probably 2.5 years. However, the total cash flow is not there. So I think that's a really good transition into our next topic. If we were to kind of sit down and walk through investors, with investors at any stage of the game, and this is something that we've been doing with our small group in the accelerator program for this super team. But let's walk through. Let's talk. If you're just getting started and you're buying that first property, I think a big factor is, what are you trying to get out of real estate, right? Are you and what does your income profile look like? If you're let's say a W-2 and you hover around maybe 100 grand and you don't have the money that you're going to be able to buy these big 800, 900 $1 million properties, well, maybe you do have to target a market like the Midwest and try to get a high cash on cash return to be able to make your money back quicker, right?
Yeah, absolutely. I mean, there's so many factors that go into determining the right market for you. Budget is the biggest. People all the time, they say, "Oh, I want to buy. My budget's 500,000. It needs to be a beach market. In Florida." And I'm like, "Well, you're gonna maybe get a condo, a 1 or 2 bedroom condo at best." And it's like, "Well, I don't want that." And it's like, "Well, you can't find And so budget is key, I think. And also looking, I do want to talk about the cash flow thing real quick because people don't really understand. So cash on cash, when I go to invest in a property, and a lot of people talk about cash on cash. What's your cash on cash return? Cash on cash, the reason why we're talking about it is because it's how quickly we get our money back. Cash flow is the amount of money we actually get in our pocket at the end of the day. And in reality, cash flow for me is probably the number one at this stage at where I'm at in my investing career, because I am trying to use that income, obviously, like to replace my time, and my time has become more valuable. And so the cash flow has to be at a certain amount for a particular property for it to be worth it for me to invest in that property. If you're listening to this and you're a W-2 employee and you're trying to replace your income by buying a short-term rental, you're going to be focused on, sure, cash on cash is great, but it's really going to be the cash flow of that property. Now, obviously, you're going to need multiple properties to do that. And so that's where that cash, how quickly you can scale, get that snowball rolling. But you really need to identify what each property needs to cash flow, and it shouldn't be the same amount. I sit down with investors all the time, and they say, well, I need to, I make $15,000 a month, and I need to replace that income. So I'm going to try to do that with, 3 properties. So each property needs to cash flow $5,000 a month. Well, your first one's probably not going to cash flow that, especially getting started, unless you have like an extremely high budget. So, let's focus on the cash on cash return so you can quickly snowball it. But the first one is going to maybe do 3,000. The next one could probably do 5. Then the one after that, you're going to want a little bit higher to equal that out. So it's understanding that, but that long-term view and understanding that, hey, cash flow is just as important as cash on cash. So,
right. And I think for me, so nowadays I'm not really even looking at touching a deal, whether it's my own or with a partner. If I can't make at least 50 grand net a year from that deal, I won't even look at it. I won't even touch it. If I don't think I can make 50 grand from it, I'm going to pass on it. And that's just knowing and understanding, our time is worthwhile. And so kind of having that going in, that's something that, I tell a lot of investors when they first start, is because they will have that sort of cash on cash, mindset, because I do think the industry pushes that a lot, but it's really, hey, where's your time going? And, we're working with somebody in the accelerator program now who bought 3 cabins in the Smoky Mountains, and now she's leveled up to a point where she's trying to buy properties that are twice the purchase price, because she realizes, hey, I can make twice the cash flow on a bigger property, and it's going to be about the same amount of time as managing the other property, right?
Yeah, and I don't think people. Yeah, sorry, real quick. I was just thinking of this. I don't think people truly understand the time commitment to short-term rentals until they go and set it up. You're like, all right, I got to go furnish this property. I got to put all, you got your little tool to screw all the furniture together. Like, it doesn't hit until you're doing it, and you're spending a couple weeks trying to set everything up for a 2-bedroom house somewhere, and so, and you're like, wow, is this really worth my time? So that's where you start to question things. So I think that's really where it sits at, or sinks in.
Yeah, I remember the last time we were doing sort of like we did our webinar podcast format. I was actually setting up my 4-bedroom house in Ohio last time we were there. I think I had the painting tape on tape on the wall in the background of the video. Yeah, I mean, there's so much time. I mean, and one thing that I really like about your tool, and I was kind of explaining it to some other people at a conference that I was at, is, if you're going to use like an AirDNA or a Data Rabu or one of those type of tools, you have to tell it what market you want to be in. Like, hey, I need to know if I want to go into Pigeon Forge or Dustin or Logan, Ohio, or North Georgia mountains. But with your tool, it's, hey, here's my criteria based on my situation, whether it's, I want to set a purchase price to it. I want to identify a market, whether it's beach or mountains or a city. It sets that criteria there. And then you're almost reworking the algorithm backwards to find you the right markets and the right properties that fit your criteria. I think that's one of the things that I love about it.
Yeah. It's, and that's why we made it, because a lot of people, including myself, when I was looking for properties, you don't know what you don't know. You know what I mean? Like, it's like you only know what you know. Like, if you don't, a lot of people hear markets on social media and they go to them because that's what they hear, because they're learning about something new, and people are, oh, I did well. But those people who are doing well bought a while ago. They didn't buy today. They're not, the prices, the market changes. What worked last year will not work this year. That's something that we really try to preach in the accelerator and teach that. through application is understanding that you have to change your strategy. You have to change how you look for short-term rentals, because what worked for everybody else the years before, previously, is not working this year. People are struggling. I'm getting tons of emails from folks who bought last year, at the end of last year or middle of last year, who aren't getting the returns they were expecting because they were running, thinking, have the same logic as 2020 and 2021 in terms of their calculations, evaluations. And so as much as these other tools are great, the problem is it's kind of lagging information and data, and it's not helping people see where the price points are today and how the market shifts each and every single month, because that's when everything is updated. So that's why, that's what STR Insights is trying to give you, is a snapshot of that market as it sits today, not last year, a quarter ago, or wherever. So whatever.
Yeah, and that's a big thing too. I mean, I have clients in the Smoky Mountains that, no joke, bought in 2018, 2019, couple $250,000, $300,000 houses, and these things are all worth $800,000, $900,000, even $1 million now. And I try to tell them, hey, you're only making 30, 40 grand cash flow on this thing. You could sell it today and take that money and go scale up and buy more property in different areas that are going to get you higher cash flow. But the industry changes, right? And even within, I would say, not even the last year, but within the last 6 months, understanding what interest rates do to your purchasing power, or what if you're trying to sell a property, what do interest rates do to your potential buyer's purchasing power? Interest rates go up, that's generally going to bring the price of property down, just because less people can afford that purchase price. And so I think one of the things I wanted to talk about is, so let's say let's say the person that's 1 to 3 properties and they're trying to scale up. At this point, if they're still working a W-2 job, one of the considerations that we see a lot is, they're harnessing their DTI. So their DTI is going to be potentially capped or almost maxed out at that point if they have 3 properties in a W-2. What are some of the, investing strategies that you see people in that sort of that 3 to 5 property range? At this point, they've probably had that, that light bulb moment to say, hey, what is my time worth here? If I can make X amount of money on this property, but have a bigger purchase price and the same amount of time and make double, am I better off there? What do you think the biggest hurdle, I would say, to get to that 3+ property? Because you made the hurdle, you made the jump over that. What helped you get from, you have 6 properties now, right?
Yeah. So the biggest,
go ahead.
Yeah. So the biggest hurdle that a lot of people, so the first one, the obvious one, I think, is confidence in purchasing and like kind of rolling forward. And then also, no one talks about this, but this is a common issue a lot of people struggle with, and this is more of on the financial side. A lot of people, that go in with the mentality, I'm trying to replace my W-2 income. I need to make whatever it is, the example, $15,000 a month. Well, when they start making all this money from their short-term rentals and they start the snowball effect, they start drawing on that funds as well. So the amount they spend per month starts to increase and tick up. So their lifestyle is better and it's increased, but they find themselves in this weird place where it's like, well, last year, it was $15,000 a month, but now I need 20 or 25, and it's just like never ending. And they're still in their W-2 well beyond where they thought they could go. And in reality, if they just taken that money they'd gotten from their short-term rentals and just rolled it back in and been patient 3 to 5 years, they could have really been, gotten out of their W-2 and relying solely upon the real estate investments. And that's still snowballing and compounding, essentially. So I think that's like the first step people need to realize, like, if you're trying to scale, is, okay, am I spending more money now that I'm making more money too? Is that, equate? Because if it does, then maybe you need to reevaluate that, because you're just going to continue and you're not really going to actually truly scale like you think you'll want, what you originally wanted to do.
That's such a good point.
Then, yeah. So I thought I'd throw that out there. And then, so the lending starts to get really complicated, especially with your DTI. So, I mean, I'm sure you've talked about commercial loan products before, but those rates are crazy. But guys, I'm not a creative financing guru by any means. But there is some, I help people find properties, and I was helping one guy find a property, And the way, so I guess I'll preface this before going into this, but the way I evaluate the purchase price of a property, for especially for a short-term rental, because it's an income property for me, is looking at the gross revenue to the purchase price. So I will ignore the purchase price and I will evaluate what the revenue of that property is. So if it's a $500,000 home, and for me, I'm like, well, I got to make my $50,000 cash flow, so it needs to make at least, back of the napkin math here, $100,000 gross, $100,000 a year gross. So if so I'll start with the gross amount. I think this property can make $100,000. So to me, I would be willing to pay $500,000 for this property. In a buyer's market, which is where we're headed, this is definitely, and more and more, this is definitely the way people should be thinking. So especially when you're trying to scale, because now, okay, this property is $500,000, but if I look and it's listed for $600, but it's been on the market for more than 30 days. Well, guess what? I'm going to go talk to that owner, and maybe I can do some creative financing. Maybe they'll want to do seller financing, or some seller concessions or things at closing or whatever, so that I can work it, so that I can get that $500,000 deal. 95% of investors look at price first and then evaluate, and they're not thinking creatively. For me, it's an income producing property. So I want to know how much is that property going to make before I look at the price. And then I look at the price and say, you know what, we can work with this, or, I need to talk to the seller, see what they can do. And a lot of investors don't do that, and they miss out on amazing deals that are right in front of their faces in, super obvious markets, because they're not taking the time to understand from the seller's perspective as well how motivated they are.
That's such a great point. I mean, I think we could do an entire podcast just on like negotiation and just sort of financing tactics. And, we talk with John Hodge from the Super
Maybe do
Team,
that
right?
with John Hodge. Yeah, not me, but John Hodge is going to be key there.
We're going to set him up. But, one of the things, I don't know if you were on the call, but we had on our accelerated coaching call one week, we had a member who got a pre-approval from the bank for a DSCR loan. And, based on interest rates and the income verification and whatnot, well, he had to lower the purchase price or the pre-approval letter amount. And so I was thinking of that's a strategy to go to a buyer or to go to a seller, especially in a buyer's market, to say, hey, I was pre-approved for 380, but, and that's what I kind of wanted to offer you here. But, after the interest rates go up and what we're looking at in the numbers, the most I can offer you is only 340 for this property. And I think that's such a strong negotiation tactic to be able to go to a seller and say, this is exactly what I'm offering you, and here's why. This is my top dollar. I think it's so powerful.
Yeah.
Go ahead.
I'll add, sorry, I want to add this one last thing I found. This guy, I was talking to this, he's essentially wholesaling short-term rental property. So he reaches out to hosts, and he says, hey, I'm, willing to buy your property or sell your property. Are you willing to sell? And he told me, so I talked to him last week. He says that he is getting, so he sends out mailers. And, he's been doing this for a couple of years now. He usually gets about 1 to maybe 3% response rate. He said he's getting now between 10 to 15% response rate.
Oh,
so,
wow.
Guys, the market's shifting. People are interested in, considering in these houses, some of these houses, they're doing very well. And the sellers are just like, yeah, I mean, I want to cash out. It's time for me to, go on to something else, or maybe they're seeing a little bit of a setback and they want to pull out. I mean, when there's fear in the market, I think that's when you can really find opportunity. So go ahead.
Yeah. Before we get on to this, the next topic here, I wanted to circle back about the timing of when you actually get your STR up and running is super important. I know, you and Bill talked about it in the STRonomics podcast, but, I'm even thinking about it for my own self. So the ground up construction in Branson, we were supposed to start building on that in early January, and we haven't even, we're just now closing on the approval for the construction loan at the end of this month. And so, now with our project not being finished until, I don't know, August or September, we're missing the entire peak season this year of the Branson market. And so, you knowing that, it's well, now we have to kind of beef up our cash reserves because we're going to have to front, some mortgage payment and some utilities and some expenses there. Can you talk a little bit about that and what you've seen with investors?
with timing.
Yeah. In
Yep.
certain
Okay.
markets, right? Certain markets in the country, right? Or have different timing.
Yeah. So, I mean, I made this mistake, but I made this mistake last year. My peak season is from the beginning of May all the way till the end of October. And
Hmm.
after that, it is absolutely dead. There's no bookings. Yeah, well, I can't say absolutely nothing, but literally from January to April, I have zero bookings. So I launched my property in Watkins. This is my Watkins Glen property. I launched it at the end of May. So I missed about $10,000 of revenue. $10,000 that would have uh, covered my mortgage and some of my carrying costs for those months I had zero bookings. And it's because I could have, I spent way too long getting the property ready and thinking, okay, I can do some of this stuff on my own. I don't need to hire out anybody to help move. The owner's literally like sold me the property, everything in it, and it was like grandma's closet. So I had furniture, and this is a 7-bedroom, 7-bath property, and I thought in my head I could get this thing ready in 2 weeks. So, well, I know it took 5, and and it was a painful lesson. I should have just said, posted on Facebook, hey, we're giving away everything for free in this house. Come and get it, 9 a.m. And take pictures of stuff. Post it. You can just get it gone. Get it gone. That would have saved me at least a week and a half to 2 weeks of time. But I lost a lot of revenue, and that's the opportunity cost that a lot of people don't take into account. So by losing that, that sets me back a little bit in terms of timing and how quickly I can get my money back, for that cash on cash return. And so understanding your market. So if you're looking to buy in an extremely seasonal market, so beach markets, it is February 23rd. I don't know when this thing's going to roll out, but you need to be looking and buying soon, because you're going to miss all of that revenue from part of the summer season. And then when it hits the shoulder and the end of the year, there's nothing. So that timing is going to be absolutely key and crucial to understanding and really maximize, especially if you're like, this is your first property. You don't want to be carrying the costs later on. You want this to cover everything. So in cash flow in that first year. So, and because that helps you and that motivates you to get that second property and that third property. So timing is key.
Yeah, that's great. So I know we both spoke at the STR Wealth Conference last year, the inaugural conference. And I know when I gave my speech, I said, if anybody has any questions, they can find me on Broadway that night. As long as they buy me a drink, I'll answer any questions that they have. And so one of the guys came up to me, I think it was at the Dirks Bentley or Bentley Row or whatever the bar is called. It's 3 floors with a rooftop. It was awesome. And so he came up to me and he goes, Ryan, look, I'm a W-2, I'm a doctor. I have 7 short-term rentals. They were all in the Smoky Mountains. And he goes, I'm finding it hard to scale and get out of my job, right? I'm, finding it hard to get rid of that $500,000 salary. Do you have any advice for me? Because what I don't have right now is time between, running work as a doctor and then as scaling the properties. He doesn't have time. The one thing I told him, I was like, you're probably doing your own bookkeeping, right? And he shook his head, nodded his head down. He said, like that. And I was like, hey man, you got to outsource that. You have to automate your systems a little bit better, so that way you could free up some more time to either go find more properties, or maybe it's make a little bit more money at your W-2 so you can eventually try to transition out. What is your big tip and piece of advice for somebody looking to get out of their W-2 or their day job and into full-time entrepreneurship, whether it is through real estate or other business endeavors, right? Because you left your W-2 job to run your company full-time. What's your number one tip?
Yeah. I really feel like the first thing actually comes to mind, and it's interesting. I don't know if I would have said this on any other day, but that person or most people should probably hire a VA. A lot of stuff that we do, especially in the short-term rental space, can be offloaded to a VA. Not everything, and it's not something easy to just go out and hire a VA and all your problems are solved. It does take an initial upfront time of investment to understand what they need to do and how they work and so on. But a VA, so I have 14 VAs currently.
Oh, wow.
So, and they all do different things, like all the way from writing and copy and, all the way to data and data quality and checks and stuff like that. And they're in all of my different businesses. And honestly, it's, you can get them to a point where you set it and forget it. And they can take like the bookkeeping, social media posts, just all kinds of little things that you have to take the time to do. They can offload as long as you teach them how to do it properly. So for me, I think one of the biggest things when you scale any business, if you're thinking about, this is a business, first off, this isn't just something like real estate investing. It is an active business that you're involved in, and you have to be able to delegate your time away to other people. You have to be willing to pay other people to help you out and take away some of these things, because that will help you and give you the time to focus on the right things. I'm not saying I've got that mastered by any means, and I think you and I know that, but it's something we struggle with. But it is key. I mean, it's so refreshing when I'm like, you know what? I used to have to do that and now I don't. And somebody's got it for me, and I can just ask for a report or a monthly, wrap up sheet or something like that that tells me what I need to know. And that is the key, I think, to scaling and getting your time on the right things.
So for our special listeners that have taken the time to listen to this all through, can we get the secrets and the insights on, what are some of the areas that you're looking to potentially make your next investment in? Because I want to know for myself too.
You want to know for yourself? You want to know the markets? Well, for me personally, and I mean, Ryan, you kind of already know, for investments that I'm looking to get involved in are on a larger scale. So I'm looking at, and I think that's the power of, our accelerator and some of the other programs that we're going to be doing together is, working with people who are looking to really invest in bigger properties or properties with multiple units, or just like creative deals, not just a typical single family home, 3, 4, 6, even 6 bedroom. Like we're talking, maybe 15 bedrooms or so on, and in the right locations. Let me tell you this. I have found opportunity in one way or another in almost, I can find opportunity, I should frame it like that, in almost any market. It's the probability of actually getting or finding that deal that works, that meets that circumstances. I was looking in San Diego with an investor, not for myself. I would never invest in there, but it's a cool city. And I was helping them out, and they were like, Kenny, what works here? And so I took some time and did some research, and the play there is, because you can still get a permit. Everyone who's listening says, oh no, they capped off. They did cap the permits, but not everybody applied. So they still have room. So if you're listening to this and you're interested in San Diego, better take advantage of that soon. But what I found is you can find sweet spots in every market or micro markets, and identify the best locations to invest in, and then figure out what works. It starts with understanding the gross revenue and then pricing properties off that. If private properties, there's properties in San Diego on the beach, they're multi-millions. We'll say 3 million is kind of what I'm seeing, and the revenue's maybe 400, 500,000. Well, if that's too much, what should it be priced at? And then maybe you need to do a BRRRR in that market. And in fact, BRRRRs, if you look at the data, you look and you say, okay, I can find a fixer-upper for 1.1 or 1.5 or 2 million even, and I know it can make 500,000. I can put, $200,000, $300,000 into it, and boom, that works. And that now it makes sense and the deal is there. But if you look at it, flying, 30,000 feet above it, none of the deals are going to make sense because you're just looking at price and revenue. And so really diving deeper into every single market and figuring out what truly works, what's coming to that market. Frisco, Texas, anybody listening, I don't know. I'm not I would consider investing there because they're putting in a Universal studios. And when I looked in the data, 5 bedrooms there's not many 5 bedrooms on the market, and they're performing very well. They have a higher ROI just from a price to revenue standpoint. And if you invest close to Universal, I mean, that's just going to, it's going to do even better. And so that's one market I would keep my eye on, just if you're wanting to know a market. Frisco, Texas is a great market. They do have some regulation, but that doesn't mean you can't get in there. And let me give you one more.
I'm texting my employee right now to look
I'll give you one more. So I guess a market. Oh, here's a fun one. I got a fun. So I'll throw one out there for John Hodge. He keeps sending me these like, yeah, I'm gonna send you a cease and desist for talking about Memphis. But Memphis, Texas is one of the top urban markets to invest in. My mother called me the other day. She saw a video and I was talking about Memphis, and she was like, why would you tell anybody to go invest in Memphis? She's like, do you know they have crime there? And I was like, I live in Buffalo, right? Like there's crime everywhere. Like there's opportunity also everywhere as well. And the markets where people aren't thinking about, that's not on the front of their mind, is, oh, that is this logical, or not logical, but just like psychological place that people want to invest, like a Destin or a Gatlinburg. When you hear those names, you're like, oh yeah, I'd love to invest there. But the places that people aren't saying, there's a lot of opportunity there. And so Memphis, Gulfport, Mississippi is a great example of that. It's a beach market. Terrible water. Don't know why anybody would vacation there, but millions of people do every year. And the market is excellent. It's one of the better beach markets in the country. And so understanding that and kind of changing how you think is going to be key to finding the right markets in 2023.
Yeah, Gulfport, I mean, it's got to be, the cheapest beach market to get into, I would think?
Yes.
It's got to be the cheapest.
Yeah, I don't think that even Texas coast has kind of gone up and gotten a little pricier. But, I mean, even when you think about Myrtle Beach, for example, area, like it's just the numbers don't make sense. But that's because it's a traditional vacation rental market. I'm not saying you can't find opportunity there, but just from a face value price to revenue doesn't make sense unless you do something creative. So,
yeah, the last thing before we go. So one of the things what I found really interesting is when you were showing me STR Insights tool, you were showing me to try to find trends in a certain market. So let's say you go find 6 or 7 5-bedroom houses in a market with 2 or 3 bathrooms, and you see, okay, well, these top 2 are kind of like super outliers. They're making the gross amount of revenue. These bottom 2 are kind of also outliers in the sense that they don't make as much, but these ones kind of right here in the middle, like these are typically try to be the trends and what we can kind of set our data to, and then try to outperform those specific markets. It's the same way that John Bianchi showed me in Destin when I first met him last year. You guys have the same sort of almost approach when it comes to trying to find the trends in the market and try to outperform and analyze that data. Where can people get a hold of that? Are you guys working on anything, and where can people find you on social media?
Yeah, so John and I are actually putting on an event. I'm not sure when this podcast will come out, but the event it's going to be March 9th and 10th, where we're going through how to identify properties, cash flowing properties in 2023 specifically. So John and I connected. We are probably like the 2 most biggest data nerds and very good at identifying markets and properties. And we have when we talk, I'm just like, preach, brother, preach. It's really fun. You're doing stuff with him.
I get it.
And I learned stuff from him, and I get to teach him things too, because we're kind of coming at it from different things. He works for a fund that's what they do, like a $37 million fund, and that's what he does. He's head of data there, and he goes and finds properties. Me, on the other hand, I have a software company where I have all this data and information, and so it's just fun and kind of partnering on stuff. So look at stuff. I mean, guys, I don't know. Like I said, I don't know when this podcast will come out, but we do have an event coming out. We'll probably do future events as well together, talking about data and how we use it. And so follow us on Instagram. I'm at Kenny_Bedwell, and then John is at the Airbnb data guy. So yeah, check us out on Instagram.
Well, thanks so much, Kenny. Thanks for coming on, and we'll see you guys in the next episode.
See you guys.